Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 275th VideoCast podcast for the week ending January 23rd, 2025. A ton to cover today, so we're going to get right down to it. We usually do family photos first, but these are my friends that are like family who came out to visit us in California, stayed with us for a couple days last week. This is Robert and his lovely wife, Desiree, who, by the way, has been in the running for our club championship multiple years back in Connecticut. But we got to play the club out here in Orange County, and that was absolutely incredible. Thanks for so much for coming out to Rob and Desiree. And we also had the privilege the next day to play Big Canyon in Newport Beach, which was unbelievable. Thanks for setting that up. And Jason for hosting us. And then there's a picture of me. It was actually cold that day. This week it's been quite warm. My game is coming back, which is pretty awesome. The markets close at 1 o'clock on Pacific time. Now, the flip side is I'm up at 4:30 every morning, which I don't mind. Today I was up at 1:30 because I miscalculated what time CNBC Indonesia was. And it dawned on me that the time spread might be different last night at 9 p.m. rather than waking up at 4 a.m. I had to wake up at 1 a.m. But, world's smallest violin. Let's get down to the media. Want to thank the amazing Taylor Riggs, Jake Mack, Stu Oppenheim, Melanie Kapadia, obviously Liz Clayman for having me on the Clayman Countdown, and Catherine Myers. So here I am with Taylor Swift, Taylor Swift, Taylor Riggs. Been a long day. The amazing Taylor Riggs. Love going on with her. We talked 2 weeks ago and a follow-up on the conversation we had there, how it's all coming into play. Here we go.
Got it. All right, moments ago, we heard President Trump talking about interest rates in the Oval Office after he signed an executive order on crypto. This is the first Fed meeting of the year. It kicks off on Tuesday. Joining us now, Great Hill Capital Chairman Tom Hayes to count us down to the closing bell. Tom, we love having you. What do you make of some of the interest rate conversations that we've been having, particularly as we gear up for the big Fed?
Well, you heard Donald Trump this morning from Davos, and thanks for having me, Taylor, saying he wants lower interest rates. He wants that debt-free financing. We know the debt interest payments have gone from under $500 billion to now going to be more than $1 trillion. So he's going to continue to put pressure. He's going to continue to cut costs with the DOGE program so that the market has confidence we're being fiscally responsible, and the market will take care of interest rates over time.
So I love filling in for Liz Clayman because you are my repeat guest. The last time I was on with you, you talked about, right, the last in is now going to be the first out, right? When you think about the performers in this market, are you starting to see that play out?
Yeah, there's no question. And I enjoyed being on with you a couple of weeks ago. I said the last shall be first. And what are we seeing today? We're seeing materials, we're seeing healthcare, we're seeing industrials start to outperform. And the reason is simple: business friendly environment, cut taxes, great environment for these type of businesses moving forward. And price is what you pay, value is what you get. So we came into the year with the Mag 7 having decelerating earnings growth for a high multiple, decelerating to 21% earnings growth for 33 times versus the rest of the market at a much lower multiple, and money is finding its way into the great value there.
I know, but so we only have 30 seconds left. I'm looking at Boeing on your list. It takes a lot of crossing your fingers to bet on Boeing right now, or you're happy?
Well, the big thing is with turnarounds, the key is solvency risk, and Kelly Ortberg took care of that by raising $20 billion of cash. They still have a duopoly. They still have a $500 billion backlog. So we like Boeing. We like that story. And Trump has said he wants the rest of the world spending massively on defense spending. Boeing is going to be a beneficiary. We like that story continuing.
Thomas Hayes, thank you so much. A penny for your thoughts as well. So let's take a look at this. We're firmly in record territory. The S&P.
And we're back on to the next. This was a special segment I did on the floor of the New York Stock Exchange when I was in town with Jared Blickery and Sydney Freed. Also want to thank Taylor Clothier Smith for putting this together. This is a new podcast that they have, which gets syndicated everywhere. And this was an amazing Go Anywhere podcast that we covered. China, Baba, everything you could possibly imagine. Advanced auto parts, turnarounds, how we think about turnarounds. So I wanted to get this one early in the podcast this week, so listen in here.
Welcome to Stocks in Translation, broadcasting from the New York Stock Exchange, the heart of global capital markets. I'm Jared Blickery, and at my side is the people's voice, Sydney Freed. First, please like, subscribe, and comment on Stocks in Translation on Spotify, Apple Music, Amazon, or YouTube. Guess what, guys? Today we are welcoming Tom Hayes. He is the chairman of Great Hill Capital. Hello, guys. And today we are going to be talking about, guess what? We got Warren Buffett, we got David Tepper talking of value and macro. And no spoiler alert, we've got them in a finale you do not want to miss. Our word of the day, or phrase of the day, is VSD. It stands for volatility, spreads, and duration. How the pros use these terms to read the bond market tea leaves. And this episode is brought to you by the number 21%. That is how much the Magnificent Seven profits are expected to grow this year, which happens to be exactly the same for the S&P 600. That's small caps. It's a 2025 Davy Goliath market showdown. But before we get to some of the more jargon-busting parts of this show, Tom, why don't you just give us your big picture overview of where we are in the markets right now?
Yeah, I think for 2025, we can expect a good year. However, not quite as good as 2024. We're kind of looking at high single digits to low double digits, but I think the real story is going to be the rotation. What is going to drive those gains and what is holding back bigger gains? And that has to do with rotation that we're going to talk about.
All right, great. So you are a value investor. We want to start with another V word, VSD, which really doesn't have a lot to do with value, but we're going to talk about it anyway. We got volatility, spread, and duration. So taking them one at a time, volatility, it measures price swings. And then spreads, that shows the difference in yields between two different bonds, so how far apart they are. And then we have duration, which measures how sensitive a bond is to changes in interest rates. So if the Fed raises or lowers rates, how does that bond react to it? And I'm just wondering how you use this information to judge what's happening right now, because we've seen huge rises in the 10-year T-note yield, which has been pressuring risk markets.
You know, it's interesting. What we're seeing in the last few weeks is exactly what we saw after Trump 1.0, after the election and before the inauguration. And what basically happened in 2016, he ran on being tariff man and the king of debt. So what did the markets do? As soon as he was elected, dollar rallied, yields blew out. Emerging markets and international stocks sold off. And then after the inauguration, what's surprising to most people that they forget is that bonds actually rallied, yields compressed, the dollar came down, and international stocks did exceptionally well. China had one of its best years ever in 2017 after the inauguration. So I think there's a lot of bark to the headlines, but more modest bite, because that bark is used as a negotiation tactic. And I think we're going to see a period in 2025 that's similar to 2017 in that how people are positioned today before the inauguration is probably a little bit offsides to how the year is going to go.
And you want to go ahead? How do you see this playing out, though? So you're a value investor. Tell us how you see this playing out sector-wise or style-wise.
Yeah, I think in terms of sectors, what drove the boat late last year was the Magnificent Seven. And what you saw with the Magnificent Seven was they had meaningful earnings growth, 33% earnings growth last year. That is actually decelerating in 2025. It's
crazy to think, but yeah.
It's decelerating down to 21%. But the difference is the multiple has remained elevated. So the multiple has not been derated with the earnings growth. Conversely, you look at something like small caps had anemic earnings growth. The small cap 600, which is the more profitable index, is going to grow from 8% earnings growth to 21% earnings growth, but rather than paying 33 times, you're paying 16 times. So I think you're going to find the real opportunity in the unmagnificent 493, in international, in small caps. And that's why we're going to see more subdued index returns of 8 to 12%, because Mag 7 is such a heavy weight. And if they don't outperform, the indices aren't going to go very far.
So what are some of your investment ideas that aren't Mag 7 that are more 593? Sorry, 493. I gave more,
well,
more stocks.
You want to do some auto stocks? You ready to go to sleep? No, these are exciting stocks. I've got one on the retail side and one on the wholesale side. So the one on the retail side is called Advance Auto Parts. This stock is down 80%. And why? Because it was mismanaged. They overexpanded. Everyone knows Advance Auto. You know, they see it in their local area. If they don't see O'Reilly, if they don't see AutoNation.
I can hear the jingle, yes.
Yeah, exactly. So effectively, Shane O'Kelly came in. He ran HD Supply for Home Depot, a $7 billion business, Harvard MBA, West Point, serious guy. Came in about a year ago to turn the thing around after they destroyed it. What he did immediately was he took solvency risk off the table. How did he do that? He sold the Canada business, raised $1.5 billion of cash, the Westpac business, paid down debt, and now he's closing the unprofitable, non-performing stores on the West Coast. And part of the reason they're not performing is because they are spread out. So you don't get economies of scale with the distribution hubs. So he's shutting that down. That's 10% of stores. He is expanding stores in the markets in the Northeast and on the East Coast where he's number 1 and 2, consolidating the distribution centers. Here's all you need to know. His target for 2027 is $630 million in operating income. They've done that 4 times before, 2018, 2019, and 2 other years. Every single time that they hit that marker, the stock traded between $180 and $220 a share. It's a $45 stock right now. You can't give it away.
Maybe 3 times appreciation.
I love that you have specific investment picks like this. Yeah. How do you go about stock picking? Because you've been on our air many times.
Yahoo Finance Screener?
Yeah. And you always have like an interesting ideas and specific ideas. How does an average person get specific ideas as opposed to just investing in ETFs?
Yeah, I think, 1, it comes from experience. 2, I'll give you the advice that Warren Buffett gives everyone, which is read The Intelligent Investor by Ben Graham. And once you can understand that the price that you see on your screen can sometimes deviate and sometimes deviate materially from the underlying fundamentals of the business, that's when you read that book and 1 of 2 things is going to happen. 1, it puts you to sleep. Find another career. There are many ways to make money, many paths to the top of the mountain. Number 2, the light bulb goes off and it changes your life. That's what happened to me. And every day, like Buffett talks about, I skip to work because it's like a treasure hunt. There is nowhere else in the world other than public markets where the price can get so dislocated from the underlying value, either due to forced selling, structural selling, over emotion. You know, for some of the prices that I pay for businesses, like if I went into Advance Auto Parts board today and I said, I'll take out the entire company, JP Morgan's going to finance me on the debt side, I'll put up some of the equity, I'll raise some equity, we'll buy the entire company at $45 a share. I can guarantee you.
Sounds wonderful.
They would call security and have me escorted out of the building because they think I'm absolutely a Looney Tune. Never in a million years would they sell their business at $45 a share. So those are the opportunities, and that's actually one of my filters is, would the board have me escorted out if I offered to buy the entire business at the price that was quoted in the market? And if the answer is no, they would take the meeting, then that's probably not the stock for me.
Tom, speaking of value here, value has actually been the dominant probably factor, if you want to call that, in the market going back 100 years, but not this century. It's really only come in a few places, come into vogue in a few places. And I've sat with a lot of guests and they've said that perpetually low interest rates that we've seen this century kind of killed off the macro trade that, you know, you're used to these boom bust cycles, but it's changed the game. It did change the game so much. And only now are we normalizing. So is this finally the time for value?
Yeah, we ring the bell on this show.
All right.
Look, value is the cheapest relative to growth since 1980, number 1, since 2000, number 2. Both of those years were generational buy opportunities to buy value. If you remember the covers in 1999, 2000,
yes.
Warren Buffett has lost his touch. That was the headline, except he was using that opportunity while everyone was buying Cisco and Global Crossing and Enron. He was buying value stocks, and he had dramatically outperformed 2000, 2001, 2002, 2003, 2004, 2005, 2006. You get the point. And if you look back through history, we get blinded as investors by recency bias. And recency bias tells you since 2010, growth has kicked value's butt, okay? And there's no 2 ways about it. Since 1927, value has outperformed growth, not by a little, by 4.5% per year, every single year, including the last 15
And not
years.
compounding. That's,
Yes. If you believe we're normalizing interest rates and you don't have exposure to the 493 or some level of value, I think you're going to find yourself left in the dust. I'm not saying shift your portfolio overnight and go all value, because we don't know. No one can predict the future. But what I am saying is, if you can buy a high quality business at a reasonable price right now, you want to start to do that in a normalizing environment, and that's exactly what we're doing.
Would you do that with an ETF like buy VLUE or some value ETF, or are you stock picking? Do you really need to find the winners and avoid the losers there?
Yeah, I think you run into, if you wind up in a basket, there's the term value traps. So the turnarounds I look for, it's not just like it's cheap, because you can get stuck in cheap for a long time. I'm looking for catalysts of change. In many cases, it's the new CEO. Okay, so for instance, we were just joking. You like Vans? I have
Love
three.
Vans,
We have 3 pairs of the same.
Can't see them now. That's
Okay.
not going to happen.
I had
but
to
we-
endure this conversation already.
So look, let me tell you about Vans. So Vans,
Please.
I went on a network last year, and the stock was trading at $13 or $14, down from $83. And the host looked at me like I had 2 heads. I said, look, I'm betting on Bracken Darrell. This guy was at Logitech in 2013 when the stock was down 82%. Okay? Here's what happened over the next decade. If you invested, it was less than a decade. If you invested $1 million when Bracken took the helm of Logitech, you made $26 million. 26 bagger. Talk about a
mice.
turnaround. And this is not, they weren't curing cancer. These are commoditized
They were selling mice.
camera and mice and keyboards, which you could get anywhere else. But somehow this guy figured out how to brand Logitech to the gamers, and the game was on. He's doing the exact same thing. And not only does VF Corp own Vans, which has struggled, by the way, it peaked during COVID. Everyone bought Vans 3 years ago. They've got three.
There's a surfing vibe early on in the pandemic. Didn't pan out.
Exactly. Didn't pan out. So they've worked through that. So now they've gone through the destock cycle. They're going to the restock cycle. But by the way, they own North Face, which just did a collaboration with Kim Kardashian on Skims. They sold out within a matter of days. The young kids are wearing the new school where the wave thing pops out from the side of the thing. So he's changing the game. They're selling out. You couldn't even get them in Christmas because they were selling out. Then he owns North
couldn't
Face.
get them in Christmas.
He owns North Face. He owns Timberland, Dickies. So he's got a portfolio. He sold off Supreme to do what? Same thing that you saw with Shane O'Kelly. Take solvency risk off the table. That is number one in a turnaround story. Sold Supreme for $1.5 billion, paid down the debt. Now they've got the runway to turn around Vans. North Face is doing great. As Asia comes back, it'll do even better. Timberland, Dickies, you name it, you got it. I mean, Bracken is a winner, and he's gonna turn this thing around. So the stock is now up from 13.14 to 21.22, down from 80. I think this can double again over the next couple of years.
Hold that thought. We need to take a short break. But coming up, we've got a Davy and Goliath showdown between the Mag 7 and small caps. Then another showdown on the runway featuring 2 iconic hedge fund legends. It is Buffett versus Tepper. Coming up. All right, we are back, and this episode is brought to you by the number 21%. That is the expected growth in earnings per share or profits of the Mag 7 this year. And it's also the expected EPS growth for the S&P 600, which covers small caps. The key difference is what we call the multiple, or how much you need to multiply the stock price to get to that number. So the multiple on the Mag 7 is 33. The multiple on the S&P 600, that small cap index, is half of that, basically 16. Tell us about how you use this information.
Yeah, this is huge. So when I'm allocating this year, I want to find special and unique situations in small cap. Why? Because I get the same growth for half the multiple. Price is what you pay, value is what you get. And the second auto stock that I wanted to talk about is a small cap in particular. It's called Cooper Standard. This stock is down not 80%, this stock is down 90%, okay? Same thing that happened. They took solvency risk off the table, they refinanced the debt. All this is a play on increasing volumes. And if you remember from December, volumes came in, it surprised everyone, 16.8 million annualized. What you've seen over the last 45 years is North American sell-through, SAAR. It peaks and troughs between 15.3 million to 17.1. The last time you had a peak was 2017, at 17.1. This company earned $7 a share and traded at $146. We started buying it at 5 and change. It's now up to 13 and change. We believe that the next time we hit 17 million in volumes, they're not only going to earn $7, they're going to earn $10 a share because they've taken $400 million of costs out. So these are the special, unique situations in small caps where you can get involved. You can take a risk. You're not going to put your whole portfolio in a small cap stock. You want to be careful, and you want to have a portfolio of 10, 15, 20 stocks. The less confidence you have, the more diversified you need to be. The more, Buffett and Munger used to always say, diversification is a hedge against not knowing what you're doing.
Or some would call that incompetence, but yeah.
Bigger picture, do you have like a percentage breakdown you recommend for growth and value and large cap and small cap for people to be invested in?
Yeah, that's going to depend on their unique goals. That's something that they definitely want to talk to a financial advisor, because at different ages, you want to have different levels of risk. I deal exclusively with family offices and ultra high net worth accredited and qualified investors. So that's really going to depend where you're at. I think for a lot of people, what makes sense is to passively index the bulk of their money. And then if they have a small bucket where they want to start to learn and start to experience and start to experiment, they're doing it with a very small, and as they grow confidence and grow experience and grow knowledge, then they can expand that bucket over time.
But we've had a number of people, guests on this show, that have told Sid and looked us in the eye and said, well, you're young. Well, they looked Sid in the eye, not me. They said, you're young. You don't need the rest of the S&P 500. You just need the NASDAQ. You need some of the growthier stocks. You don't need bonds. What would you say to that?
Yeah. They said that in the late 90s also. I mean, look, I don't think this is the late 90s. I don't expect a tech wreck. I do expect some consolidation of some of these gains and some re-rating of the multiples. Sydney probably has to speak to her financial advisor about that.
I thought you were advising me right now.
But if you were my sister, I'd put you in a few good companies, and then I'd probably have you indexing the rest, so you slept well at night and you were comfortable with that. And then over time, you could build up as the profits and as your account grew, and as you got more comfortable with that.
What about small caps, though? Are those for...
And as the group, like, would you trade the Russell or the S&P 600, or you're just looking for individual?
Yeah, I mean, we run a very concentrated book of 8 to 12 stocks is our portfolio.
Different ballgame for you.
Different ballgame. I would say, though, that I would start to ease into a small cap index. Do it small if you're like 90% in like a 60-40 portfolio. Maybe you put 5-10% into small caps and start to lean in that way. The other thing you can do, some people index with the S&P 500. There's a Vanguard ETF VTI, which is a broader number of companies that you'll catch some of the small caps in that. It's another way to index, but with more exposure, less concentration to the Mag 7. That's another thing to think about as well.
There's a new S&P 500 ETF that will not weight any stock more than 3%. So it's not quite equal weight. It's just all kinds of interesting products coming out like that. If you don't have anything.
I have one thing about diversification, just because I've asked this before, but I feel like if you have a long runway, is there something valid to just like putting a little bit of money in every S&P sector? Is that
This is a recurring thought. You're like, how can I get it all? Catch them all.
Because people say diversification. I'm like, what does that really mean?
Yeah.
Like stocks, bonds, sure, but like a little bit of money
Sounds like
everywhere?
a good excuse for not knowing what you're talking.
Exactly.
Well, I think you're getting that effectively through the S&P 500. So if you look at the spider sector ETFs, and then you look at the holdings of each of them, you're going to see like the top 10 holdings are S&P components. So effectively by doing that, what that would change is your weighting. So if you went equal weight by sector, but that means you're going to have equal weight materials against equal weight tech, which by the way is not a horrible idea for 2025. I'll tell you why.
Yes, please do.
The two among the worst performing sectors were healthcare and materials, had low single digit returns in 2025 relative to the S&P over 20%. Here's what's going to happen in 2025. They have among the highest expected earnings growth. Healthcare is going to grow earnings 20.4%, which is more than the S&P 500 of 13-14%. and materials is going to grow earnings 17.4%. So as a catch-up trade, that becomes very, very interesting. I have a materials name if you're interested, but otherwise
we might get to that in a second here. First, we got to get to today's Who Wore It Better. We have two iconic investing legends marching down the red carpet. It is, on one side, the Oracle of Omaha, Warren Buffett himself, squaring off against the master of macro, David Tepper. Buffett, the steadfast value investor who built his empire on patience, discipline, and the occasional cigar butt strategy. He is the epitome of Jesse Livermore's buy it right and sit tight strategy. On the other side, you've got Tepper, a guy who just doesn't play the markets, he moves them. With just a few words on financial TV, he stared down the global financial crisis and famously said, "Load up the truck." So, in this battle of investing icons, who wears the market better? Is it Buffett's timeless value playbook that shines in high-rate environments, or Tepper's all-weather global macro toolkit ready to pounce on any opportunity here?
All right. Long-term Buffett, hands down. Near-term Tepper. I'll tell you why Tepper.
Sure.
People are going to tune out when I say this. I hope
listening.
not. It's certainly going to be controversial. So Tepper went on TV a few months ago talking about China, and people vomited all over their desks once they heard that, okay? His number one position is Alibaba right now. Look, I've been wrong about Alibaba for over a year. We just keep buying it and buying it and buying it because price is what you pay, value is what you get. It's the lowest amount of price for the greatest amount of value right now in the international market. So if you think that there's more bark to Trump than bite and he wants to do a deal with China like we saw after the election in after the inauguration in 2017, when Alibaba went from $85, not coincidentally where it is right now, to $187 in 11 months, you might want to take a look at that. There's something that has been happening in China for the last year and a half, is that they've been doing this piecemeal stimulus over and over and over and over. Very piecemeal, but it's all building up. And when it happens, it's going to be very quickly, and Alibaba is the toll keeper. It's the toll gate for the middle class. When they start spending, they get a piece of all the action. They've got a piece of all the AI startups. If you want to play a China AI ETF, it's called Alibaba. Why? Because every single AI...
They are a seed fund.
Every single AI startup goes to Alibaba and says, we need cloud, we need AI tools, we need all of this stuff. And they say, it's free, just give us equity. We've got equity as owners of Alibaba in pretty much every AI startup in China. This is huge, and it has zero value. Oh, by the way, they generate $25 billion of free cash flow every year. Oh, by the way, they're sitting on $55 billion of cash. Not a bad runway for a turnaround situation.
They can also lock up Jack Ma at any time, so there is risk there.
Yeah, well, good news is he's out of the picture, so lock him away. I would say that if China turns, this thing is going... And I wouldn't even say if, because this is actually what it looks like. I know I don't have a lot of gray hairs, but I've been around, and Jared knows. I've seen these cycles, and the last time China was this despondent was, it happens every few years. 2016, okay? Then you had 2009. Then you had 2001. As the money moved out of U.S. tech, it moved into China tech. So look, it's not a popular one. It's why we own more than one stock, okay? You can't be certain about anything, but when it moves, it's not going to be a little move. It's going to be a big move, and it's not going to let anyone in. And I just don't know when that is. I think it's imminent. Tepper thinks it's imminent, but no one knows.
Tom, we're racing to the finish here. What is your number one investment tip for 2025?
I think that what you want to do is lighten up a little bit on Mag 7 if you're overweight. And if you're in indices, whether you like it or not, you're overweight. Some 40% index weighting is the Mag 7. I think it's trading at a little premium. You know, I joke Jensen Huang may be flying a little bit too close to the sun like Icarus. The good news is his wings haven't started to melt yet, but at 51 times earnings, 30 times sales, decelerating growth, still great growth, but decelerating. Having been through many semiconductor cycles, the narrative is the same. Competition is coming. Right now, the wings are fine because there's no competition. Competition will come.
All right, we got to leave it there. Tom, I'm thinking about becoming a value investor when I grow up, but for now, we got to wind things down here at Stocks in Translation. Be sure to check out all our other episodes on the Yahoo Finance site and mobile app. We're also on all your favorite podcast platforms, so be sure to leave a comment, subscribe wherever you get your podcast.
And we're back. And then I had the pleasure to join the great David Lynn, who has one of the most vibrant, active audiences you could imagine. You go on his show, your phone rings like crazy because he's so good at asking questions and digging deep. So we're listening here. The purchasers of these technologies will be required by their investors to get a return on investment. So they either lower the spend and risk ceding market share to their competition, or they get more compute power per dollar of spend. Competition catches up, and it's a race to the bottom for margins, and this time will be no different.
Will the sell-off in January continue well after the inauguration? We'll find out with Thomas Hayes, managing member of Great Hill Capital. He'll also break down his sector allocation preferences and value versus growth, an interesting theme for 2025. Thomas, welcome back to the show. Happy New Year.
Thanks for having me, David.
Let's take a look at my screen right now. This is the S&P 500 ever since basically the top in December. It's down roughly 5% or so. Is this just a seasonal pullback that we're seeing, or is uncertainty around the Trump administration starting to pile up here?
Yeah, I think it's not dissimilar to the volatility we saw after the election in 2016, Trump 1.0, through the inauguration 2017, and then things kind of normalized. I think what's got people sideways is yields blowing out, 10-year yield accelerating. First, you had the Fed uncertainty in December, and then you had that super strong jobs report, which worried the market that maybe we're not going to get the 2 cuts that the Fed projected in their SEP. And instead, now we're at only 70% of 1 cut by October, and the market is adjusting to that. And if you look at the general indices, it's almost misleading. You know, you had industrials, small caps down almost 10%. It was pretty violent interruption in December. You had seen a trend of regular broadening, healthy broadening since July of last year. And then as we got through the election and into that Fed issue in December, really an abrupt pause in that broadening theme. And I do think we're going to resume that for a number of reasons we can cover today.
The 10-year yield, is that a signal of strength in the economy or expectations for further strength in the economy, or simply that the inflation expectations are being pushed out higher, which may or may not be good for equities?
It depends who you talk to.
Okay.
I mean, if you look at the University of Michigan, inflation expectations jumped up a little bit last week, both on the 1-year and 3-year expectation to 3.3%. That is embedded in the consumer's expectation of tariffs increasing prices. Now, you have seen the administration leak a couple of things. Number one, maybe it'll be targeted to certain industries or subsets. And number two, it might be gradual. We've been of the camp it won't be as bad as advertised. I think the advertisement was 60% tariffs across the board. I think that's going to be more modest and more reasonable, like we saw in Trump 1.0. Then on the flip side, you do have the fact that the economy is growing. You know, you're going to have mid-teens earnings growth. So there's a view that yields are expanding due to that. And then there's a third viewpoint that you got to issue $9 trillion of debt to refinance in 2025. So that yields are blowing out in excess. But what I will say is, I'm more of the camp that this is exactly what happened between the election and the inauguration in 2016 to 2017. Trump ran as the king of debt, the king of the tariff king. He's run on the exact same platform in 2024, and the market is trying to digest to what extent will he be the king of these two initiatives? We're taking the under. The market right now is taking the over. I think the market is overestimating because, as you saw in 2016 to 2017, while the dollar rallied after the November election and bonds yields really accelerated after the election, after the inauguration, bonds got bid, yields compressed for the next year plus, the dollar rolled over, international stocks took off, biotech stocks took off, oil stocks collapsed. So it was the exact opposite of what everyone was expecting. And we think it could be some version of that, rhyming, not repeating.
Yes. And as a hedge fund manager, are you positioned for more of a pullback right now, or is it still risk on for you, generally speaking?
We run a concentrated equity portfolio that has a very low correlation to the S&P 500 weights. Mm-hmm. So the businesses we buy, we enter, we do a lot of turnarounds, and we're buying at a point in time where we feel the margin of safety is extreme, meaning that if the business was liquidated tomorrow, we would make a profit. If the turnaround plan plays, we make a double or triple over a few years, and in some cases, multi-bagger. So we're less concerned with what the market's doing on a day-to-day basis. If the market pulled back 20% in the next couple of months, it wouldn't change one view on any of the 8 or 12 core positions in the portfolio. And very likely, if the indices pulled back, which we don't anticipate anything of that magnitude, but if they pulled back materially, what that would tell me more likely is that the rotation that we've been talking about is playing out, because the indices pulling back is evidence of the Mag 7 predominantly getting hit because of the weights in the index. And we're going to make our money in the 493 and international prospectively, which would be less impacted by the overall market liquidation.
Thomas, you talked about some sectors that surprised some investors, or would surprise some investors during a Trump 2.0. So let's talk about some of these. So we actually discussed this in detail when Trump won the election. Link down below. Thomas was on one of my first guests after November 7th. In particular, energy is interesting. And the oil price right now is moving up a lot higher. Now, some of it had to do with sanctions on Russia, but perhaps expectations are that Trump is actually going to follow through on some of his promises. What do you think is going on in the energy sector right now? Yeah,
we have exposure to the energy sector to a company called Comstock Resources. Jerry Jones, who owns the Cowboys, owns about 66% of the stock at around $7.10. Our basis is about $1 higher. It's now trading around 20. We believe the intrinsic value of it, both proved reserves, PV10, that they have to report to the S&P 500, around $20-30 per share, and then unproved, we think, is another $20. So we don't really worry about the day-to-day vacillations in natural gas or in oil prices. I would say that sentiment got so pessimistic on oil and oil stocks in December that it was clear that we would get some level of bounce. The problem with the integrateds and even some of the servicers is that when we get involved in a business, we are looking for a meaningful IRR over a few years, 30% plus. And I just didn't find the risk reward, despite low quote unquote PEs and high dividends and buying back shares, et cetera. I just didn't find the asymmetry in the general oil and gas space that I did during 2020 when we were buying it hand over fist when oil turned negative. That's when I like to get involved. So for now, our exposure is limited. If you put a gun to my head and said, how are you going to take advantage of the increased drilling and the energy favorable policies from the Trump administration, I'd be inclined to be in servicers, potentially like a Schlumberger or something like that. We have no position there, but if we do expand our energy exposure beyond Comstock, that is where we would be looking. And it would not surprise us at all if we see some follow through, both in the sector, because that's a component of value, which we think is going to have a better year than it did last year, and some of the initiatives as far as the consolidation in the industry, deals happening in the industry, et cetera. It's just we're not getting enough juice for the squeeze, so we're looking elsewhere where we can get a lot of juice.
And how are you eyeing the tech sector now that Trump has probably signaled a doubling down of tariffs and the trade war globally? Is the tech sector at risk from tariffs and just more protectionism overall?
I think that as we look at the Mag 7, which is an overweight in the indices, so you are dramatically overweight tech if you own the S&P 500 passively. and dramatically overweight if you're chasing the Nvidias and the Googles and et cetera. The thing that our view is the outperformance of the Mag 7 last year was somewhat justified by the earnings power of the Mag 7 last year. So it's okay to have a 33 times multiple when you have 33% earnings growth. The problem going into this year is that earnings growth is going to decelerate for the Mag 7 from 33% down to, it was 21% as of a few days ago. Now I've seen numbers down to 18%. So your earnings growth is going to almost halve, but the multiple is still at 33 times. So the multiple is still high. It has not yet derated. So that's not where I want to be. Where I want to be is where is the earnings growth accelerating and the multiple has not re-rated to the upside. One of those areas for sure is small caps. You're going to see in the small cap 600 index earnings growth grow from 8% to 21%, but you're only paying 16 times. So half the multiple as the Mag 7 for the same or slightly more earnings growth. If you look at the Russell 2000, which has more non-profitable companies turning profitable, that earnings growth, I've seen some estimates to be 50% this year. So I think that's an area. The other theme that we're looking at here, David, is the last shall be first, right along the theme of the earnings growth relative to value. Two of the worst performing sectors last year, because they had among the worst performing earnings growth, were healthcare and materials. This year, that is going to flip on its head because the healthcare is expected to grow earnings 20.4%, which is meaningfully more than the S&P at 14, 15%. And materials is going to grow earnings at 17.4%. So we like opportunities in those two beaten down sectors as well.
Speaking of valuations, here's a note from Goldman Sachs. Their strategist put out a note on Monday. It's reported by CNBC. U.S. stocks are expensive, but GS says investors should keep buying them. The U.S. stock market is trading at eye-watering valuations, says his article, after 2 straight big years for the S&P 500, but that's not good enough. A good enough reason to back away from domestic companies. The 2025 outlook for the unit released on Monday included a model portfolio for moderate risk investors that recommended staying overweight U.S. equities while trimming exposure to foreign stocks. Is that something that a view that you share?
Okay. So Goldman's 2024 outlook was the most pessimistic on the street. Their target price for end of year was 5,400. The S&P wound up well over 6,000, and at one point in the year was at 6,300. So they got it wrong. They were the most wrong on the street. Now, prospectively, when value stocks, speaking of prices, what you pay, values, what you get, international is going to have 14% earnings growth. That's ex-US. Compared to the US, about 14% earnings growth. The difference is US, you're paying 22 times. Internationally, you're paying 15 to 15 and a half times. I think now more than ever, just like the first year, 2017, when Trump was elected, when everyone thought you had to be all US, international and emerging markets actually outperformed after the dollar rolled over after the inauguration. So I would take the exact opposite of this note from Goldman Sachs this year, just as taking the exact opposite of their note last year was the right call as well.
And it does beg the question as to where capital flows will head now that the Bank of Japan in particular is on a path of potentially raising rates while everybody else is cutting rates, if not pausing.
Yeah, by the way, this is the most important thing to be watching in 2025. We got a preview of coming attractions in early August as the Bank of Japan is forced to continue to raise rates and the Japanese bond yield, JGB yields blow out. What you're going to see is an unwind of the carry trade, and the carry trade, that free money trade that has been concentrated in quote unquote US exceptionalism, but predominantly Mag 7 stocks, is going to abruptly unwind, because as that liquidity dries up, it's coming out of where it's been placed. And that has been in the Mag 7. They've not been buying, small cap auto part wholesalers. They've not been buying Stanley Black & Decker tool makers. They've not been buying Baxter International medical device companies. They've been buying NVIDIA, they've been buying Palantir, they've been buying all of those things, which I think are going to take a breather. And by the way, I'm not saying short tech, this is 2000 at all. I'm saying that there's going to be a re-rating in multiples, which will cause the performance of that basket to do less well than it did last year, i.e. low single to high single digits, whereas bigger money can be made in value across the board. And we can talk a little bit about the history of value versus growth and why growth people seem focused on due to recency bias. If you'd like to move there.
Well, wait a minute. Is Apple still a growth stock? Ditto Microsoft. And,
well, look, I mean, the story with Apple has been multiple expansion, right? So historically, it had traded at a 14 times multiple on 7-8% earnings growth, or actually higher earnings growth back then. And then it decelerated earnings growth to low to mid single digits, which is where it is now. And the multiple expanded into the 20s. So you tell me whether that makes sense. Now, the bull's argument would be that services revenue increased and services profitability increased. Therefore, it's deserving of such a higher multiple. But at the end of the day, if you have decelerating earnings growth and accelerating multiple expansion, it's a formula for not great things happening moving forward. So I would just say that we don't have a view that the multiple has to go back to 14 times by any stretch of the imagination. But we do have a view that some of the gains that have been fostered through multiple expansion versus earnings growth expansion should consolidate the gains for some time to digest the price growth relative to fundamental business growth that has occurred in the last 2 years.
Okay, so the main drivers of tech earnings then going forward in 2025 in particular, do you think it's still coming from AI? Do you think that theme has sailed? What's your take?
The narrative of AI and the expectation of AI transforming lives is correct. Just like the narrative of Amazon changing the world in 1998, 1999, 2000, 2001, 2002 was correct. The problem was in that first part of the shakeout, even though everyone was right about the story in 2000, it took 10 to 15 years to deliver the result, i.e. I press a button on my phone and, here in California, in sometimes the same day, it shows up at my front steps. Sometimes it takes a whole day to do it. So all of that stuff happened. The problem was you were paying as if it already happened in 2000 when it would take 15 more years to deliver, which is why you saw in 2000 to 2002, the greatest company in the world, Amazon, down 90% in price, despite the fundamentals of the business continuing to improve in each of those years, 2000, 2001, 2002, 2003, while the price was crashing, the fundamentals were improving because you had simply paid too much for what was to come 10 to 15 years later, as if it had already come 15 years earlier.
Yeah. So then bottom line please.
So as it relates to AI, I made a joke. Jensen Huang is flying. The bad news is Jensen Huang is flying too close to the sun.
Yeah.
The good news is his wings aren't melting yet. I mean, you have a company that is trading at 30 times sales, 40, 50 times earnings. And if you look at CapEx spend from the Mag 7, it's going to decelerate this year as it relates to AI because investors are demanding, they made record CapEx in 2024 on AI chips. Jensen Huang was the beneficiary, but now there's something called return on invested capital that investors demand in order to allocate capital, and it's eroding their return on invested capital or return on equity, depending which metric you like to look at, because they're not getting the revenues commensurate with the spend in the near term. So they have to temper that. That's number one. Number two, once you have all these large language models trained, and I'm not saying that's done, as we move to the inference part, once the language models are trained, the inference requires less hardware because it's less demanding. It just starts to make use of the large language models, and the demand for the chips goes down. So I do think you're going to see a re-rating of some of these arms dealers in the AI race. And the third thing I would say about NVIDIA is like, it's worked well because he's had no competition. But like every semiconductor cycle, and a lot of people that are betting on NVIDIA weren't even through puberty the last time this happened, and they don't have any point of reference. But competition is coming. Okay, they're not curing cancer over at NVIDIA, that I can assure you. And the chips will be replicated, or even substandard versions that people can buy at quantity at price will start to replace, particularly again as we move from large language models to the inference phase of the cycle. And the purchasers of these technologies will be required by their investors to get a return on investment. So they either lower the spend and risk ceding market share to their competition, or they get more compute power per dollar of spend through cheaper competitive chips. And what we find, as we find every single semiconductor cycle, is that chips are a commodity, and sooner or later competition catches up, and it's a race to the bottom for margins, and this time will be no different.
Two questions on that. First, good point on competition. So competition from where is my question. If there is going to be competition, why hasn't it already happened is probably the question on the street. Intel, I know they got rid of their CEO. They're searching for a new one. AMD hasn't caught up. Taiwan Semi, I don't know. What's your take?
Well, Taiwan is in the best position. They're in the thing is, if Taiwan this is the thing that people forget. If Taiwan Semiconductor ceases to exist, there is no NVIDIA. So NVIDIA can design chips, but if they can't produce them, they have no business. So as much as there's pessimism around the Intels of the world, which, if they just liquidated the thing now, investors would get their money back plus a few dollars. The U.S. has invested $8 billion of real cash and then billions of subsidies and everything else. So whether they stand up the fab or not, or put it into a separate entity, first thing they got to do is announce a new CEO. I think when all is said and done, what you'll find is that everything Pat Gelsinger said was going to happen, he had basically gotten to the 10-yard line, and they took the ball away before he could cross the finish line. He did the 4 nodes in 5 years. He burned a lot of cash, so he had to go. The board got the board. So the name of the game is they need to hire someone and announce someone who's credible, and then just finish Gelsinger's plan, because everything's in place. And if they can get the fab business going either in the current entity or in a separate entity, and they can catch up, I think that one's got an interesting possibility relative to margin of safety of, if you're conservative and you don't believe in their future as a fab, it's probably a double just on the legacy business. And if they get the right CEO, and if you do believe in Gelsinger's full plan, then this thing could be a multi-bagger. But leaving that aside, the AMDs will catch up, the Marvells, the Broadcom. There's a lot of people gunning for a piece of the Jensen Huang pie. And like every cycle, you can be assured that they will get some of it. Not all of it, but they will get enough of it that you'll see margin compression and you'll see a normalization of multiples.
Last question on AI and NVIDIA. This came in this week. NVIDIA stock falls after Biden administration releases updated export rules for AI chips. So the stock's been down about 13% since its top in late December. But anyway, this came out. It fell nearly 2% on Monday after the Biden administration released an updated export rule aimed at controlling the flow of artificial intelligence chips to adversaries such as China. The White House said that the rule will cap the number of AI chips called GPUs that can be ordered by most countries without a special license. Smaller orders of 1,700 or fewer GPUs would not count toward the export cap. Is this significant for the industry at all, or not so much? I mean, do you expect this to be reversed?
It's significant for the industry, but not for the reasons that you think. Okay. Number one, in the short term, it will hurt the industry a little bit. In the intermediate term to long term, it will destroy the industry, because what you basically did in the name of national security is you've taken a eager paying customer to US companies and said, you can no longer buy from us. So you've given them no choice but to learn how to create that competency for themselves. And how do they do that? It's very simple. They pick off the best talent, they reverse engineer the technology, and they do it themselves. Whereas if the government did not impose these restrictions, they would stay dependent on us forever. So effectively, in the short term, it looks like a win because they don't have the same technology. In the intermediate term, after they ship the chips through other countries and ultimately get them and reverse engineer them, and they front loaded a bunch before of this anyway to buy them a few years to reverse engineer the technology and hire out all the best talent. The big issue is maybe the competition that I'm talking about is not coming from the players that we're anticipating, and it's coming from players that are just now getting going and from China.
Great. Thank you very much. Let's close off on your sector overweights and underweights for 2025, summing everything together.
Yeah, I think three themes here. First, values outperformed growth by 4.4% per year since 1927. So we want to be skewed toward adding value this year. And the recency bias around value in the since 2010 has been zero interest rate policy. If you believe we're going back to zero interest rate policy, then stay overweight growth. If you believe we're in a normalized environment, which we do, start adding some value into the portfolio. The second theme is small over large. You get the same or better earnings growth for half the multiple this year. It worked in Trump 1.0. And the third theme is start to get some international exposure because like value and growth that runs in cycles, international and US runs in cycles. And when you see a headline, US exceptionalism, the note that you referenced, it's often time to start to get some exposure internationally. Again, 13, 14% earnings growth for 30% less multiple. International is the thing. As far as domestic, last shall be first. Healthcare and healthcare for sure, and materials are ways to get value for massive earnings growth acceleration in 2025. And I think that one of the surprises of 2025 is that following the inauguration into the first quarter, I think you're going to see bonds start to get bid, 10-year yields start to get bid, yields compress. And I think that the pounding the table around 5% is going to be more like 4% would be my bet as we move throughout the year. I take the under. I'd see the 10-year yield closer to 4% than closer to 5% towards the end of the year for sure.
Interesting. Okay, good. Thank you very much. Where can we learn more from you and hedge fund tips?
We have our blog, which is hedgefundtips.com. We publish our weekly research note on Thursdays and our top ranked hedge fund podcast. It's called Hedge Fund Tips with Tom Hayes. You can get it wherever you get your podcast. You could also get it at YouTube. Just put in Hedge Fund Tips in the search bar and all of our stuff will come up. At X, it's at Hedge Fund Tips, and at TikTok and Instagram, it's at Official Hedge Fund Tips.
Excellent. We'll put the links down below, so make sure to follow Tom and Hedge Fund Tips there. Great resource for anybody interested in markets and updates. Thank you very much for your update today, Tom. We'll speak again soon. Take care.
Thanks so much, David.
Thank you for watching. Don't forget to like and subscribe.
And we're back. And then this morning at lovely 1:30 a.m., I had the pleasure to be on CNBC Indonesia, Closing Bell, talking Trump policies. This is a good one, so listen in here.
Eksklusif bersama dengan Thomas J. Hayes, Chairman and Managing Members Great Hill Capital yang bergabung dari California, Amerika Serikat. How are you, Thomas? It's been a while.
I'm doing great. Thanks for having me, Safrina.
Thank you for joining us in CNBC Indonesia. Just barely 3 days ago, Donald Trump has been inaugurated as the 47th President of the United States of America. So what is your outlook for the U.S. economy?
Yeah, I think we're going to see a very positive, high growth economy like we saw in the first few years of his first term. Certainly positive impact on the economy, positive impact on the stock market. And it's really going to be driven by tax cuts, lower taxes, lower regulation, more business-friendly environment. And I think the other aspect of what we're going to see, Safrina, is a more broadening in the participation like we saw in the first term. People at the lower level of the income strata are going to do a lot better, just like they did in 2017, 2018, 2019. We're also going to see a lot more sector participation. U.S. markets have been pretty concentrated in tech participation, Magnificent Seven. I think we're going to start to see a lot more companies in industrials, manufacturing, banking, energy start to participate, small caps, et cetera. So a lot of broadening and good performance in stocks outside of the Magnificent Seven moving forward.
And also the labor force market, as you mentioned.
Yes. Yeah, there's no question about it. There are going to be better wages. There are going to be more jobs. There's going to be a lot more investment in the U.S., a lot more manufacturing. You know, manufacturing has been in a recession or even a slump for 2 straight years. I think you're going to see some policies and some investment that's going to make manufacturing boom again. That's going to create a lot of high-paying jobs.
And beside the manufacturing industries in the United States, what do you believe will be his key priorities to strengthen your domestic economy, Thomas?
Yeah, I think there are a few, Safrina. Number one is going to unleash the beast of U.S. energy. We have unlimited, beautiful natural resources. Drill, baby, drill. He's going to open up leases on federal lands for drilling. Reduce regulations on offshore drilling. So we're going to have an unlimited abundance of cheap energy to fuel industry. You saw the Stargate investment project yesterday, $500 billion. That's going to require a tremendous amount of energy, all types of energy, certainly natural gas, certainly oil, certainly some nuclear is going to be in the picture, certainly renewables. We're going to need that. The other thing you're going to see is lower taxes for individuals, lower taxes for corporation, which is going to foster a lot of investment and high nominal growth, high GDP growth. The other thing you're going to see is a business-friendly environment that's going to attract a lot of foreign investment. You saw Masayoshi-san and others committing $500 billion to Stargate AI infrastructure investment. And just today, MBS from Saudi Arabia said we would invest, they would invest up to $600 billion in the United States. So a lot of people want to do business with Trump and America. And then finally is peace through strength, getting us out of wars, creating a peaceful geopolitical environment through a strong national defense and spending on defense. So those are kind of the core tenets of things we're going to see that are going to lead to growth and stability under the Trump administration.
Right. I would like to hear more, and I want you to elaborate more about his inauguration speech, essential topics with the popular catchphrase, drill, baby, drill. What do we need to anticipate from that as from the emerging markets point of view?
Well, I think that there is a perception that Trump is going to want to do trade wars and tariff, and emerging markets will do poorly. And I think what we saw in the first Trump administration, was exactly the opposite. So the two things that people expected in Trump 1.0, when he ran as the tariff king, was that the U.S. dollar was going to be very strong and emerging market equities would be very weak. After the inauguration in 2017, the exact opposite happened. So right after he was elected, the dollar rallied and emerging market stocks went down. Right after he was inaugurated in January 2017, you saw the dollar back off, started to weaken in that first year. You saw emerging markets and China stocks start to do exceptionally well in those first 2 years of the 2017 administration. So I think there's going to be a difference between what people expect, i.e. international emerging will do less well, and what actually happens. I think the whole world is going to do well, and I think emerging market stocks are going to boom. I think that commodities are going to do well, and I think it's going to be fueled by a lot of investment, a lot of growth, a lot of optimism, and good policy, win-win policy globally.
Right. Thank you. Now moving on to the digital assets. How do you anticipate the Trump administration's approach towards the Bitcoin, the digital assets, the cryptocurrencies? Will there be significant new regulation in this particular sector?
I think it's going to be nuanced. Certainly, it's going to be more crypto friendly. He ran on that to really attract a lot of people who own crypto assets to vote for him. And I think he'll follow through on what he promised. So there will be a focus on innovation. There will be a focus on deregulation. You see Scott Bessent, his Treasury Secretary, has spoken positively about crypto. Howard Lutnick, his Commerce Secretary, owns Bitcoin, has invested in crypto companies, vocal supporter of Bitcoin. And then the SEC chairman, Paul Atkins, is expected to take a softer approach to crypto regulation. I would keep in mind, though, that further adoption and further rules are also going to foster more competition, more issuance. So it started out straight away with the Trump token and the Melania token. So, all these folks that are in Bitcoin and Solana and other instruments may start to see a lot more competition for those crypto dollars, because I think there's going to be a lot more issuance of different tokens and different crypto opportunities. So it potentially could have an effect that people are not focused on, which is dilution. People say, well, Bitcoin's the best thing ever because it's scarce. But if the regulation becomes more friendly, you could have a lot more tokens and crypto investments that may, in fact, dilute the couple that currently have a duopoly on the crypto investment funds.
Right, Thomas. And this is Trump 2.0, as we mentioned here. And given the history of the previous trade war, do you think we will first see the possibility of a trade war 2.0 between the U.S. and China under this Trump's leadership?
I think that first and foremost, I think that's a headline that's unfair. I think what Trump wants to do is threaten big, okay, and then negotiate a favorable win-win deal, okay? And if you look at the big focus has been on China. China is a small portion of our global trade. It's about $600 billion of, call it $5 trillion. He came out of the gate and he said 60% Trump's tariffs on China day one. Well, now we're talking about 10% tariffs on China, and it wasn't on day one. It's going to be pushed off till February. So I think, as it relates to China, his number one thing is stop allowing this fentanyl to go through our borders. It's hurting a lot of our people. So he's going to use the tariffs to get the Chinese to cooperate on those issues that are very, very important to the U.S. There probably will be some level of tariffs, but it will be a lot lower than advertised. And then once that framework and agreement is in place, I think it will foster a lot more business between the two countries versus the previous administration that consistently said China was wrong and never got to the table to do a good deal.
But how do you particularly see the relations between Donald Trump and Xi Jinping?
I think they're actually a lot better than is advertised on the headlines. I think they're already communicating. It's been announced that they're communicating. I think there's a level of mutual respect, a willingness to talk and a willingness to come to a table. Look, Donald Trump is an America First president. He wants to do what's in the best interest of America, but he understands in business, in order to get what he wants, he has to have a deal that makes sense for the other party. He's been doing this for his entire career, business career, going over 60 years at this point, and he will come to a favorable deal. And I think we'll have very positive relations with China and with our other trade partners after a little bit of volatility to come to good terms. And that's the way negotiation works. You ask for everything, and then you come to a good win-win solution.
Now for the geopolitical situations, given the ongoing humanitarian crisis in Gaza, do you think the U.S., under the administrations of Donald Trump, should play a more active role in providing or seeking a resolution? What do you think Donald Trump's going to do?
Well, I think if past is any prologue in Trump 1.0, we saw record world peace. It was really the situation. So I do think he'll be involved. I do think that will be resolved much more quickly than it possibly could have under the previous bureaucrats and administration. I think that leaders around the world respect Trump and know he means business when he says to come to the table and he's going to do a deal, something's going to get done. So I do see a situation where geopolitical issues are going to be much more muted. We're going to get rid of all these multi-front wars. We're going to come to some negotiated resolutions through Trump, peace through strength, and it will be good for the world, and we can focus on business and global prosperity.
Right. Wonderful insights always from you, Thomas. Thank you so much for joining us in CNBC Indonesia. Take care.
Thanks, Safrina. Appreciate it. And I want to thank Fitria Angrani and Safrina Nasution for having me on that one. And then a couple nights ago, I was on CGTN America with Sean Calebs. Also want to thank Camelia Kilowan for having me on. We'll listen in here.
Welcome back, everyone. He was chosen by Trump to, in part, cut government costs, but it appears he has been cut. Vivek Ramaswamy announced his departure from the Department of Government Efficiency, or DOGE, to possibly run for governor of the state of Ohio. However, various source-based reports say Ramaswamy was iced out by Elon Musk. Ramaswamy was tapped by Trump alongside Musk to streamline federal spending. Now, with his exit, Musk is now fully in charge and leads the push to cut government waste. Some say Ramaswamy's departure is reminiscent of the many leadership changes seen during Trump's first term in office. So what exactly will Elon Musk do? Key initiatives include modernizing outdated systems, as well as implementing cost-saving workforce reductions. Drawing from his corporate experience, Musk aims to overhaul inefficient federal processes with a tech-driven approach. However, these plans have sparked legal challenges and also raised concern about potential impacts on essential government services. Let's take a closer look at that. And for that, we're joined by Thomas Hayes, founder and chairman and managing member of Great Hill Capital. Thomas, always a pleasure. Welcome.
Thank you.
Good to see you.
Good to see you, Sean.
Okay, so what do we know about Doge? It seems like it's a moving target. Day 2 in office, and we're back to this kind of chaos that seems to follow the current president. Elon Musk firmly entrenched, but as we heard, Vivek Ramaswamy out, and Trump saying Doge will be entrenched in the executive branch, not an outside committee. I know just threw a lot at you, but how important is this going to be to the U.S. economy, and what ripple effects do you expect to see through the markets?
Well, I think this is a big deal, Sean, because as you know, the interest expense has ballooned in the last few years, nearly doubling from under $500 billion to now over $1 trillion a year due to interest rate increases and spending, 120% debt to GDP. So it's absolutely essential that not only does this initiative work, but more importantly, that it is perceived to be working, because I don't think we're going to get $2 trillion of cuts. And I think Elon Musk has intimated as much by saying, well, $2 trillion would be nice. $1 trillion is more realistic. I think if they got $500 billion, it would be huge. To get out of this type of mess historically, the number one thing you need is massive growth. And I think this White House is keenly focused on massive growth through deregulation and through tax cuts and through other growth initiatives. But we do need a perception of getting that spending under control, and that's what Doge is all about.
Yeah, this perception is important. And look, this isn't the first time a U.S. president has vowed to cut the fat in federal government. And Trump, in his first term, added more money to the federal deficit than any president. So tell me why this time things are going to be different.
Well, I think that there's no choice, okay? In order to get the interest rates under control, he wants to bring interest rates down. You can only control that through the Fed, which is an independent body. And the long end of the curve is really going to tell you whether the market believes they are getting the spending under control. But, there are some sensible ideas that are coming out as a function of this dialogue, which is, consolidating a lot of these redundant government agencies or making them more efficient. Even you've heard the idea of reducing the number of them from 400 down to 100, which would be a tall order, probably a wish list more than a reality. But if we move in this direction, it's going to send the right message to the market. More people will want to buy our debt. We can refinance at lower rates while we wait for growth to pick up a bit. Yeah. Growth has been good. It could get better.
Thomas, you make some great points, and that there is a need to do this, to kind of streamline government. So what role will Doge play, if you will, in cryptocurrency regulation? And I ask this because the president, the first lady have launched their own crypto. So the fact that he has that and a billionaire is overseeing overall of this, does it kind of smack of trouble down the road?
Yeah, the crypto thing is pretty gray at this moment because he did appoint David Sachs as the crypto czar originally, and then David had a lot of ties in Silicon Valley that enabled him to be more of an advisor than take a major role in the administration. So there's some ambiguity about crypto. As far as Doge related to crypto seems to be a separate initiative that will be under the crypto czar, that will be under other purviews besides Doge. Doge is predominantly focused on reducing the cost.
Okay, so cuts from Doge and more efficient workforce. So if you're a federal worker right now in any agency, and there are a lot of them out there, are you nervous? Are you anxious? Are you antsy? And what are the markets looking for?
Yeah, I do think you are. I think the first thing that they did was do the executive order that you must come back to work in the office 5 days a week. That will probably trim 5 to 10% of the workforce without them having to do much just to start with, because not all people can work from the office 5 days a week that have family and other commitments. So that will help. We've seen hopes or wish lists or assertions from the people involved or around Doge that they could cut 75% of government employees. That is a tall order that is unlikely to be anywhere near met. I would be a little concerned if you're not in an indispensable position. I do think there's going to be consolidation of agencies. I do think there's going to be a reduction of the workforce. All the work is going to be done in person. And as they bring in software and more efficient processes to the federal government, that will reduce a lot of make work. So I would expect to see, I'm not thinking anywhere near 75% reduction, but 10 to 20% is realistic.
Okay, you only have 30 seconds. Now, Trump has had some major fallouts with people he's been close to. What happens if Trump and Musk collide and this friendship crashes and burns?
Well, I think it's a symbiotic relationship because Musk certainly needs the administration for some of his initiatives with regard to SpaceX and automated driving and other projects that Musk is involved in. And Trump needs the expertise. You know, the one thing about Trump is he is very attentive to people who have areas of specific expertise, and in many cases are wealthy or wealthier than he is. He loves to listen to their viewpoints because he takes them very, very seriously. I think that adds a lot from Elon's credibility as it relates to tech, as it relates to some of the initiatives where Donald Trump doesn't quite have the background as a real estate developer and businessman. He's not so focused on some of the things that are happening in the economy now. And that's where Elon can provide a tremendous amount of value for Trump, for the administration, for the country. So right now, it's really too symbiotic to have a fallout, unless we saw an instance where the spotlight started to get excessively stolen, which
it gets crowded in there really quickly.
Exactly. So that's a risk, but I think it's less of a risk than people are making it out to be at the moment because they both need each other.
Okay, we'll see. Thomas, always a pleasure, my friend. Thank you so much.
Thanks, Sean.
Okay, we're going to take a short.
And we're back. And there was one more here. And finally today, CNA, which is like the BBC of Singapore and all of Asia, huge station, want to thank Audrey Tay and Sarah Al-Khalidi for having me on to talk more Trump and other implications. Listen in here.
Traders anticipating a new era of lower interest rates and cheaper oil helped push Wall Street to record highs overnight. The S&P 500 hit an all-time intraday high above the 6,100 milestone following comments from U.S. President Donald Trump at the World Economic Forum. He said he would demand an immediate drop in borrowing costs. The Dow and the Nasdaq both ended in the positive for a fourth straight session. Energy stocks tempered some of those gains, with the S&P 500 energy sector on track for its worst weekly performance since late December. Mr. Trump also told Davos business elites he plans to ask Saudi Arabia to lower the price of oil to dampen inflation. His speech comes just before the Fed's meeting next week, where they are largely expected to keep interest rates unchanged. There have been concerns that potential sweeping tariffs by the Trump administration could add to inflationary pressures and slow the Fed's policy easing path. For more of the markets, we have Thomas Hayes, chairman and managing member at Great Hill Capital. Thanks for your time, Thomas. So gains for Wall Street, but it's really been concentrated in a very narrow part of the market, despite expectations of growth under the Trump administration. So do you think it's time to move on to other previously unloved parts of the market, or is it time to bet on these tried and tested names because of the uncertainty that we might see?
Well, Sarah, I think what you saw today, and thank you for having me, by the way, was a continuation of a trend that started last July, which was the broadening of the market, what I call the unmagnificent 493, everything other than the magnificent 7 in the S&P 500, really started to outperform up until December. And right after the election, and with some Fed uncertainty in December, Mag 7 came back abruptly in December. But now we're seeing a resumption of the trend. The last shall be first. Those sectors that underperformed last year are beginning to outperform. And you saw it. Healthcare was up today. Industrials were up today. Materials were up. And guess what was down? Magnificent 7. And that's the type of economy that we had under Trump 1.0, was a broad participation of regular everyday businesses starting to flourish, from deregulation, from lower taxes, from lower energy, more abundant energy, and less regulations.
Yeah, speaking of energy, we've heard his comments about how he plans to lower oil prices, which could counter the inflationary effects of tariffs. Producers, though, of energy, they won't be happy with that plan. How realistic and how effective do you think these measures will be?
Well, I think he is going to be able to lower it short term. And I think the producers will be okay with it, because the demand for energy is going to go up so dramatically with all the demand from AI, from the AI investment and data centers and the required energy. We're going to need all the energy that we can possibly get, whether it's natural gas, whether it's oil, whether it's coal, whether it's nuclear, whether it's renewables. Everything is going to be part of that pie. In addition to lower energy costs to reduce inflation, there is expectation that the Department of Government Efficiency, DOGE, will maybe not get $2 trillion of cuts, maybe not even get $1 trillion of cuts. But if they start to move towards $500 billion of cuts, it's going to signal to the market that this administration is serious about fiscal responsibility. And as a result of those actions, what you're going to see is the market is going to bring interest rates down versus Trump simply demanding that interest rates go down. The market is too big for any one of us, that's for sure.
Yeah, speaking of interest rates, we're also looking ahead to the Fed meeting next week. How much of the Trump factor do you think will fare into their assessment and their moves when it comes to policy?
Yeah, I think there's a 0% chance there will be an effect in policy for this meeting. However, if you recall, the boat had shifted after everyone had shifted to one side of the boat after the December meeting, and that is people expected 1 to 0 cuts, and some people are even talking about hikes until we got those inflation numbers. And now the market is more in line with the summary of economic projections that we got from the Fed at the last meeting, which is 2 cuts for 2025, but sometime later in the year, if not March, probably June, and then September is more likely. But I think the market is now aligned with the idea of 2 cuts versus this concept that maybe they were going to hike. After we saw the inflation numbers, it put the market at ease. And I think that will be reflected in some of the commentary coming out of the Fed. Certainly very unlikely that we get a cut this month or sooner than March, but more likely second half of the year, 2 cuts for sure. And that'll be positive for interest rates, debt refinancing, and the U.S. net interest payments, which have gone from under half a $500 billion to over $1 trillion. So we need to get that under control.
Yeah, speaking of rates, the U.S. 10-year yield gaining before the Trump inauguration. Now, where do you see U.S. 10 years headed?
I think this is very similar to what happened in 2016, Sarah. After the election, the rates went up dramatically. After the inauguration, they really rolled over and came down quite a bit in the year of 2017, his first year of his first term. Same thing with the dollar, rallied after the election, and then after the inauguration weakened quite a bit, and international stocks did well after the inauguration part. So I think we have the exact same theme happening. Rates went up, dollar went up. Now it's after the inauguration. They're starting to come in a little bit. I would expect to see that theme, which very few people are positioned for. A lot of people are crowding into a long dollar, crowding into short bonds. I think you want to be on the opposite side of that trade. Yields lower, dollar lower for the next 12 months, and that will take a lot of people by surprise, but it will be good for the global economy, good for the U.S., good for markets.
Thomas, we'll see how it all pans out. Appreciate your insights. Thomas Hayes there, chairman and managing member at Great Hill Capital.
And we're back. Quote of the week from a guy I've never heard of named Bill Bonner, but what he says is, if you look carefully, almost all old money secrets can be traced to a single source, a longer-term outlook. We couldn't agree more, and we try to impart that every single week. And for those of you who've been with us for a while, you see these things. They take time, and when they go, they go. Whether it's the latest ones, VF Corp is almost is knocking on the door for a double. Comstock is knocking on the door, probably be a triple pretty soon. And that's just the beginning. There's so much awesome stuff happening. Got to take the long-term view. Europe wasn't always such a bargain, so it talks about the valuation gap wide and that closing. We'll talk a little bit about that this week. Here's a dollar chart. People crowded in, the most that they've been this crowded into long dollar since you rubber banded back every other time in history. Let's get through these charts quickly because we got so much going on this week. Small caps bounced off this trend line. This is an interesting chart. Before 1992, the average recession was 19 months. Now it's 8 months. So that's something interesting to show. Going back to 1945, something to keep in mind. Maybe the Fed is more active than they had been. Price is right. Fed's 50 basis point cut. This shows 10-year yield rolling average annualized returns. And you can see when it gets this beaten down, you get a move in TLT. So I think someone asked on Twitter today, do you still think yields are going down? 100%. It's not going to be because Trump demands that they go down, but that certainly won't hurt. What is going to be is Doge starts cutting, the market starts to perceive all the things that we discussed on the interviews. You can see here sentiment is at the right levels, not levels you want to be a seller, which we've been talking about, and we've seen now that follow through. Commodities long-term returns starting to pick up here. We're seeing in natural gas and others. Small cap stocks need to stay above the 2021 highs. They're going to do that. I think that's going to be the big story here. We're already starting to see. Today was a great example. Upturn now, but flip-flops galore. So this is talking about the phase one recoveries that we've talked. Here's where we are, where value small size starts to outperform, coming after the high quality, large size, which we saw last year. And this is just a normal, regular regime. You got to know what phase you're in and take advantage. This is indicative of that. Going back to 2021, dividend yield inexpensive versus history. We've been talking about that for 6 months. That is now playing out. Been neglected by managers. Value versus growth. Best generational opportunity since 2001, and before that 1980. History doesn't repeat, but it does rhyme, and that's what's happening. Growth versus value at ex-COVID highs, well above the tech highs. We've covered all that and why it's based in fundamentals. It's not just looking at charts and saying it has to mean revert. Why does it have to mean revert? And you can look at the data and the earnings deceleration versus acceleration and the policies on the table, like we covered with Sarah on CNA. So I just like to show this stuff. Value outperformed growth after the last Fed cut. We're going to see more of that. China City's home price tracker ticking higher. And I'm moving fast because we just got like so many Ask Me Anything questions this week and so much great information. It's like a fire hose in January. It will slow down. Next week will probably be a lot slower, and then you'll be saying that the podcast is too short. But look, I just do my thing. It goes to show, I mean, this is like 10% of the work we do. So, and by the way, congratulations to all the clients that got in under the wire. If you put in your paperwork and we've talked and you didn't fund yet, but you're in the process of getting approved by Interactive Brokers, we are closed to new inquiries. But if you're finishing your process, you can go ahead and do that. Super excited. This is going to be one of those raises, I believe, that people have come in the last few quarters. It's going to be like the raise in fall of 2022 when everyone was sellers, and those of you who came in did unbelievable. And March 2023, when I was pounding the table, you got to come in now, and a lot of you did, and it was just unbelievable. So this is everyone in the boat right now. We're gonna rock and roll. I'm super excited for you. Those who come in the future will find things for you to do, but there are certain times when you got to take action, and this is one of those times. And I'm super excited for everyone who stepped up to the call, and I'm super excited for us, and I'm really more super excited for you. I've been through these cycles, and I know what's happening, and I'm excited for everyone that's with me. Chinese stocks, best week in 3 months, consecutive days with more than 70% of stocks advancing. So you see that coming out of big troughs. That's good news. And what happens 1 year later, on average, up 10.63%. So breadth is improving. We don't need to over hit that. Also, S&P 500 after not touching the 200-day moving average for a certain period. This is all the fun strat stuff, which is great and bespoke. A year later, you're up 13.4, which is in line with what we're thinking for the indices, 8 to 12. And for under the surface, fortunes are going to be made. They won't move the needle on the indices because the weights are low right now. Those weights will go up, just like what happened with energy in 2020 when we were pounding the hell with Exxon at $33 and saying, oil was negative. We're saying buy the hell out of everything in oil. And then after they all doubled and tripled, everyone got interested in oil. We were laying off, and they did nothing for 2 years. So housing affordability, this has to change. It's going to change. Trump's going to find a way to deregulate, build like crazy, smaller footprints, more houses, bring down the cost much more. Earnings growth is expected to broaden. We've covered that a million times. Truckload demand is going up. That's a good indicator. Truck indicator and ISM move together. Trucks are going up. ISM is going to move up. We're coming out of this manufacturing recession quickly. What else do we have here? Goods and services consumption starting to improve. Materials, sorry. Highest operating leverage you can see here, industrials, consumer discretion, energy. We've got the industrials exposure. We've got the materials exposure. Healthcare is another piece, which we've been talking about in the context of last shall be first with Taylor 2 weeks ago, and now that it's happening 2 weeks again. And then demand recovery equals higher margins. We're seeing this in earnings. Things are positive, ladies and gentlemen, and animal spirits are certainly back. The question is, how much is priced in? And the answer is a lot's priced in for Mag 7, not a lot's priced in for Unmag 493, International Small Cap Value, the things that we're in, which are now starting to get bid like crazy. Existing home sales, we know that story. FX could be a much bigger headwind in 2025. So I think that's where you're going to see some guidance issues. You had a strong dollar in Q4. That's going to weaken, but that's going to make guidance more conservative, which is typical in the first quarter of every year. Guidance gets super conservative. They'll use the FX as an excuse, and then the dollar will weaken, and it'll say, oh, what do you know? We did better than expected. Secret to happiness is low expectations. My buddy Rick got me a ball mark I use every single day that I play, which just reminds me to chill out, have fun, and let things drop. And I got to say, my game was an absolute disaster when I came out here, embarrassing disaster after 3 or 4 months off, and it's starting to click again, and it's super exciting. It's funny. All right, we'll talk about my golf game another time. Moving along, semiconductors. This is talking about the return on invested capital that I've talked about with hyperscaler CapEx decelerating and margins compressing and all that stuff. They're not getting the return. All this stuff that we think is going to happen, how AI is going to make the world great, is going to happen. The question is, how much is already priced? The answer is enough for us to be more interested in some other opportunities that are going to be the beneficiaries versus the investors in all that CapEx. Seasonality, weakest guidance period, we just covered that. GDP now is tracking at 3%. That's not an environment that you see a recession for all the negative Nellies that were out there the last few weeks. Good luck. Fed manufacturing index through the roof. This is all in line with what I've been saying. What follows when those indexes rock and roll is the ISM. We rock and roll. Years of stagnant economic cyclicality. We are finally set for a reacceleration in 2025. When they're talking about economic cyclicality, they're talking about ISM manufacturing and service. It's been dead for 2 years. We've been in a manufacturing depression like 2007 to 2009, like 2000 to 2002. And then what happened? Straight up value, small caps, industrials, all the things that make the world go round. Super excited. Beige book activity ticking up. China GDP, 5.4, crushed estimates. No one's talking about it. They will. They were all worried about that. Trump and Xi had a beautiful call. Trump said he was 60% day one. Now it's maybe 10%. Maybe do a phone call. Maybe China helps with Russia and gets off the hook completely. Maybe they do a TikTok deal, and maybe no one has any idea what's about to come except for the folks on this podcast. Industrial production going up in China, not down. Retail sales going up, not down. New home prices are starting to recover. Existing home prices starting to recover after 4 years. China new home prices stabilize with stimulus push. Stimulus, that's all pig in the python. It's starting to come out. It's going to come out all at once. It's built up, pushing the beach ball underwater. When it comes out hot, and it comes out aggressive, and you won't be able to catch it. And that's going to be super duper fun because we're gonna make up on one position, 2-3 years of IRR in probably 6-9 months, and exceed our IRR hurdle that we internally commit to for what we do in terms of internal expectations, and then set external expectations much lower. So pretty excited about that. Global LNG shortfalls are forecast until 2027. Comstock, baby, you rocking and rolling. I remember we couldn't give it away at 8. Now at 25, everyone's interested, sending me all these natural gas articles and everything else. It's like, okay, thank you. So advanced decline, breadth is starting to improve. All the things that we've been pounding that got sidetracked in December are now coming back on trend. Since July of last year, manufacturing production through the roof. That's aircraft and parts. That's exciting. Economic surprise index moving back up. That's cities. Sources say Intel is an acquisition target. Maybe it's Elon, maybe it's someone else. The key is it's in play. One catalyst or another. Either they get bought, and if it's a good enough company, hopefully we get stock and we can continue to ride it. If it's or we could get a new CEO first and they say we're not for sale. Short term, it'll sell down and then it'll go up because basically Gelsinger's plan is 99% done. They quit at the 10-yard line. So we're excited about that. Trump trade memorandum won't impose new tariffs day one. We saw that. 10-year yield is coming back down, just like we thought it would after the after the inauguration. We talked about that on CNA. Largest monthly rotation into EU stocks in the past 25 years. When's the last time this happened? Going back to when? 2001, which we talk about every single week, and also in 2014, another great good time for those international stocks. Boom, out of US into Eurozone, rock and roll, baby. Why? Partially, Japan's going to start hiking. We'll talk about that. Chinese stopped weakening their currency, so we got a little bit of dollar strength relative to yuan. That's what you see before rallies in China equities. Big move, one of the largest moves in over half a year. Decade to date inflows of equity funds, nothing into international, everything into US. This is going to flip on its head in 2025 and 2026. Here's the value of US trade goods by partner. All you really need to know here is, I didn't have this chart, but basically China was like 590 billion of 5 trillion of trade. They're actually not a huge amount. Anyway, moving along. Number of executive orders by president. So everyone's saying Trump is out of control with his executive orders. Pales in comparison to FDR, Herbert Hoover, Warren Harding, etc. Interest rates since 3000 BC. We see these spikes. Everyone keeps looking at recency bias, thinking it's going to be like 1980. It's just the opposite. These are regular things that you see over the last few thousand years. They spike up, they come back down, they spike up. Mostly a downtrend with the exception of 1980. And that's why everyone's got their thinking backwards on this. And, even in different periods. So that's that. Top 10 companies percent of S&P market cap. Look, this is crazy town, ladies and gentlemen. So you can chase these, but eventually you're going to get hurt. Maybe it's 2 years from now. There's a saying, the market can stay irrational longer than you can stay solvent. That really only applies to people who use a ton of leverage and are day trading, people, and get sell the bottom, buy the tops, and get, just whipsawed around. If you know what you own and you're paying a good price is what you pay, value is what you get. You don't worry about the short-term fluctuations. You're not getting margin called because you're on very low to no leverage. And you just ride it through until you get your doubles, triples, quadruples, and then you lay it off to all the people that are excited about it, that were selling to you in the hole when no one was excited about it. And you rinse and repeat, and you do it over and over. This is not rocket science. It just takes ice in your veins. And for most people, they say, I have regular temperature water in my veins. I'm going to lay it off to the guy with ice in his veins so I don't have to think about it, and I can go be brilliant at my business that makes all the money and lay off the cash for someone else to manage so I don't have to think about it, and they can go to the beach and enjoy life with their family. Percent of companies outperforming the S&P 500 since 1990. So we haven't seen this level of companies underperform the S&P since when? Since the early 2000s, when what happened? Small caps value international started to dramatically outperform. Here we go, same thing. This is the relative performance to US versus ex-US, and this is at a level of 2-3 standard deviations above the mean, well more than the internet bubble, well more than the Nifty 50. So keep piling into those and pray for the best. You better make sure you put a lot in the basket when you go to church, because you're going to need it. U.S. value versus growth relative performance. So yes, we see the ZERP era. Value had outperformed growth for 7-8 decades, and then you have a zero interest rate policy for a while, which is over. Unless you believe rates are going back to zero, if you're stuck in this, good luck, ladies and gentlemen, is all I have to say. U.S. duties collected, we've covered this before. For everyone saying tariffs are going to cause a depression, we have the lowest tariffs that we've had in hundreds of years, in over a century. And even in the Spanish flu 1918, we started at 6% of duties collected on total imports. We're currently at like 3%. So even if we went to 6%, they raised tariffs from 1918 to 1930 from 6% to 20%, almost 20% before the Depression. So everyone's saying if he does tariffs, we're going into a depression. Obviously, he's never read a history book and is kind of a joke. But there are plenty of people who don't read history books that are pretty, always wrong and never in doubt and unburdened by the facts of history. But global share of automotive car production by country region. China's kicking butt. They've just been taking share from everyone, and U.S. has been losing share because we are in the business of healthcare and annuities, not making cars. But we're making enough cars that Cooper Standard is going to rock and roll, and Cooper is also benefiting from China. If you listened to and read the most recent conference calls, they were surprised how well their China partnerships were going. And I'll leave it at that. You can do your own work on that. Commodities 10-year annualized returns coming back like a phoenix from the ashes, just like the early 2000s and other cyclical periods. It's not often stocks break a record dating back 97 years. It just did so with the sixth straight session with 2 out of every 3 stocks in the S&P advancing. That is a positive sign of breath. Here's China. Anytime you've seen shorted interest at this extreme, always preceded a major rally in China stocks. We are twice as extreme as we've been during those periods, which means the beach ball is pushed twice underwater. When you have that level of pressure, acute pressure, when it is released, the move will be so abrupt and so massive that people will just miss it, is really what it comes down to. They'll be buying up double and triple, and we'll be handily helping them out and giving them all that they need. Here is new regime sends Chinese tech outflows to extreme. We view this contrarily and opportunistically. We agree, by the way. Nice chart here from RenMac. Seth Golden forwarding fund strat stuff. When ISM is less than 50 for at least 12 consecutive months, delivers positive returns both 3 and 6 months, forward some 92% of the time. And you can see here 12 months out up 9.4%. S&P earnings analysis. What do we have here? Q4 2024 earnings results relative to consensus up 8.9%, 75% of companies beating. I think that's gone up. We'll cover that with FactSet a little bit later. Stocks have done quite well in the first year of a new presidential term lately. You can see going back to 2025, it's always a good year, and quite a good year going back to 2009. So we'll see if that repeats. I'm more conservative than this, but I'd be more than willing to accept another amazing set of returns. EU passenger car registrations going up, just like US, everywhere going up, up, up. Incentives going up, volumes going up, margins for OEMs going down, units going up, which benefits the suppliers. Bank of Japan heads toward rate hike as market take Trump in stride. Hike means carry trade unwind, means Mag 7 pressure. Trump says he's considering a 10% tariff on China beginning as soon as February 1st. This was a few days ago. Today he was saying he has a great relationship with Xi, and he wants Xi to help on the fentanyl. He wants Xi to help on Russia to get the war done. And if Xi helps, he's going to get bennies. And if he gets bennies, then these stocks are not priced for that. And we could see something like we haven't seen since 2016, which is 2017, where they just go parabolic in 11 months. Equity positioning across sectors. So no one's in real estate, materials, and healthcare. What's been doing the best? Healthcare materials, which we talked about before the end of the year. No one believed us. That's what's happened. Everyone's in tech. And they've been basically grinding sideways since the summer. If you look at it honestly, they were down going into December. They had a rally, so it feels like everything's going up. Go look at it back since July when we got out of the Amazon and the Google that more than doubled. You'll see. Consensus on the U.S. dollar is bullish, contrarily too bullish. We agree. Dollar's going down. Yields are going down. Household debt to income is relatively low in the U.S. Consumers in good shape. U.S. net interest expense we covered. Was $500 billion. Now it's over $1 trillion. They got to start making some cuts with Doge. We covered that on CNA. Covered the Chinese yuan. S&P 500 after McClellan oscillator goes from negative 120 to positive 100 in 30 days. 1 year later, up 15.6%. These are all breadth things. Here's that December car sales volume, which blew the doors off expectations, 16.8 million annualized. Now, if we actually get a number above 16 annual, we're going to mint money at Cooper. Things going to shoot out of a cannon like a rocket, and we're going to mint even more coin. If you all have been with us for a while, we started building the position in May 2022 at $5.10. It's now 16. That it hasn't even begun. Is our view. Moving on from my buddy sending me over. This is some of the Slumer stuff. You can see the S&P closed at record highs. The momentum is just turning up on a weekly basis, so that's good news. 10-year yield rolling over. Momentum is overdone and weakening. Same with the dollar. Momentum overdone and weakening. Sentiment mid-level. That's not what you see at tops. Utilities starting to bounce. REITs starting to bounce. We've told you that was coming. Here's Albemarle, beautiful chart. Broke the trend, back tested on its way up. That's our material exposure in addition to Comstock. Very excited about that. Here's a keynote from Hartnett over at the Bank of America Fund Manager Survey. I love looking at his contrarian trades. He's one of the best strategists in the business, in my view. Sometimes he goes off the rails, but most of the time he's right in line. He talks about the huge rotation into Europe. Biggest, most bullish surprise being China growth expectations. And then contrary trades, long commodities, long resources, long EU, UK, emerging markets for risk on if tariff and bond concerns unfounded. Our bet is that they are unfounded. They're going to be less bad than advertised. We've been setting you up for that for a while. It's now starting to take place. Length in, Mag 7, tech most vulnerable in that situation. So we are well ahead of that curve, but always love to read his notes. Some news of the week. China directs funds to stabilize stock market amid Trump tariff threats. China's consumer sentiment approaches tipping point to soar after stimulus barrage. That is from UBS. Could be nearing a tipping point as consumers save less and spend more following last September's stimulus blitz. Household excess savings grew at a slower pace and declined in the third quarter, while social retail sales rose 3 to 4%. According to UBS, the Swiss bank attributed this reversal to diminishing scarring effect of the COVID-19 pandemic, as well as supportive government policies, etc., etc. Trump holds off on immediate China tariff, calls for study. Take 4 years to complete that study. Xi calls for proactive macro policies to keep China momentum, seek progress, maintain stability. Next, Hartnett says Trump trade to shield U.S. stocks from plunge, also sees rally capped by valuations and a shift into broadening. Where is that sentence? Corporate earnings. All right. Okay. His team suggests being long on international stocks like Europe, China, and emerging markets amid policy easing in those regions. He also recommends buying rate-sensitive stocks like home builders, utilities, financials, and REITs as the 30-year Treasury yield has peaked below 5%. Agree, Mr. Hartnett. Tech war, China creates $8.2 billion AI investment fund amid tightened U.S. trade controls. We're just making them independent. Huge mistake that the previous administration made with all the sanctions. They were dependent. They were buying all of our stuff. Now they're creating it on themselves. That's when they become really a competitor and compliments of the previous administration. Chinese regulators expressed support for capital markets ahead of Trump inauguration. Is Elon Musk about to buy Intel? That wouldn't surprise me in the least. I would like some Tesla, SpaceX. Yeah, I would say Tesla or SpaceX stock. I mean, I don't know if I'd want Tesla stock. I don't want cash at these levels unless he's paying $40. Yeah, I hope it doesn't get sold. Let's put it at that. Hartnett, historic rout in treasuries ending as Trump can't allow bigger debt and deficits. We agree. Trump wants to visit China to strengthen relationship in the first 90 days. That's a report. I think that's out of News Nation. China ready to work with U.S. for steady growth of ties. Chinese VP. Bank of Japan is set to raise interest rates, Trump permitting. Traders pile into bullish China ETF wagers after Trump-Xi phone call. Sources say Intel is an acquisition target. China, which is, by the way, that's all we need is a few weeks of people speculating that it's going to get bought until they announce a new CEO. And then the new CEO will come out and say, yeah, we're kind of at the 5th yard line here. We're about to spike the ball. We're not selling to anyone. China's fourth quarter GDP grows at 5.4%, beating market expectations as stimulus measures kick in. Now, if Qualcomm was to buy them, I would take Qualcomm stock at this price. That's for sure. I would even take TSMC stock potentially at this price. So there are some options where I would take paper and be a holder, but not a lot of them. China home prices fall at slower pace. We covered that. Fed may cut rates sooner and faster than expected if inflation keeps cooling, key official predicts. China urges state-backed funds to buy more stocks amid market slump, falling bond yields. Buy more stocks. We love it. Cheap, not Trump, is why European stocks are spiking. This is from a very smart and usually pessimistic author named John Authors. I still follow his stuff because he's data-driven. Chronically pessimistic tilt, but I love the way he presents it, and I learn from that viewpoint, and it's just part of the mosaic of information I like to intake. B of A says benign Trump policies to spark rally in stock laggards. This was the note that I was looking for. We couldn't agree more. Just look if past is any prologue. We covered all that with Sarah on CNA. China Social Security Fund told to buy stocks. I mean, it doesn't get any clearer. This is what Tepper was talking about. This is what we've been talking about. They are going to throw the kitchen sink at this thing, and they're going to juice the market now that they are talking and we're getting some more clarity on where tariffs are going to shake out. With Trump saying today, we already tax them a lot we already tariff them a lot because of me, and he wants partners to get this Russia war done, start rebuilding the Ukraine, the whole story. A lot of money is going to be made rebuilding Ukraine, by the way. China eases rules for long-term funds to boost stock market exposure. China guides mutual funds insurers to invest more in stocks. You get the picture. Make up stock market and sentiment results. Kudos to Jeff Adams, who helped out with this yesterday. Did a great job. We covered all the media appearances. Bank of America Fund Manager Survey, top 5 points, most bullish. Catalyst for 2025 remains China growth acceleration. 2, managers are dramatically underweight materials and energy. 3, second largest monthly rotation into EU stocks in 25 years. 4, rotation into healthcare and commodities started the year. We talked about that before the start of the year. Hope you guys were able to take advantage. Macro outlook still has plenty of room to improve. We agree. And Estee Lauder. So we like to cover 1 or 2 stocks we've talked about previously, and in many cases have built a position. Estee Lauder, we're seeing cash flow start to reaccelerate. This was a cyclical trough, pretty much attributable to a little bit of mismanagement, a lot of China weakness, and now that's all coming back. Their long-term thing, they're going to continue to earn a return on invested capital well above their weighted average cost of capital, which is the definition of a high-quality business. And you can see historically they've been growing at 23, on average over 20% return on invested capital. Last 2 years they got hit. That's going to reaccelerate. Top line's going to continue to grow. People will pay anything to look good. This is the best brand. This owns Asia, and Asia is coming back like crazy. So you should read through all of his notations here on the Morningstar commentary. But when you read it, you are going to be really impressed and really interested. This will take a little while because it got so destroyed, but here's a stock that's down to whatever it is, $70, down from 350 at $80. I mean, look, it could hang around between 50 and 70 for 3 years before going back to 250. Who cares? But I think this one's probably going to recover pretty quickly with China, and I'm getting a lot more confidence in China where I want to get even more direct and indirect exposure to take advantage of something that happens every 5-6 years that people forget. These are cyclical things. They beat earnings. They improved operational efficiency. Gross margin improved in the most recent quarter. They got a new CEO who knows what he's doing. So all of these things position it to absolutely catapult the rebound. And China is the name of the game. This is a brand that's been around for a century plus. It's the best of the best. It will continue to be the best of the best. And if they see up and comers, which is what they do, they're phenomenal capital allocators. They just buy them and tuck them in, just like Diageo, best in the business. So GLP-1s are not going to hurt Estee Lauder. If anything, it's going to help it. The skinnier people get, the better they want to look. They're going to be doing makeup like crazy. So, and all that money they save on food and alcohol, they can put in on their face. So we love it. As I said, we closed the raise. Congrats to everyone that came in. If you're still in process, you're still in the game. If you have not reached out for the $1 million accounts, you're going to have to wait at least till Q2. 5 million plus accounts can come in anytime. We do bespoke service. But for the smaller accounts, we want to focus on investing the next 10 weeks and then revisit opening to the smaller accounts then. Defense and aerospace earnings estimates down by 75 basis points in the last 60 days. Energy down 4.5%. Again, outside of Comstock, there's nothing that we're table pounders. Paying attention to some servicers, but not there yet. 79% beat rate on the S&P 500. Estimates have held in there, so that's all positive. Jobless numbers this week about in line, nothing there. And then on to the Ask Me Anything questions. So if you like short podcasts, tune out now. We'll see you next week. If you like long podcasts, we got a ton of Ask Me Anything questions we're going to get started with right from our beautiful, incredible audience. Moving forward, guys, don't send me a question with 16 stocks to look at. I don't have time, and it's disrespectful to the other listeners. So I'll either just ignore those, or we are going to have to start to curate questions because we're getting so many. So make them good and make them count so you get included. If you don't get included, don't take it personally. There's just only so much bandwidth we have. We can't be on for 4 hours every single week. So JT Investor, seeing massive estimates about the CA wildfires. He's saying, are there building product suppliers or regional home builders set to benefit? Look, I want to bet on Brad Jacobs. He's going to do a roll-up in the space. He's whiffed on Beacon Roof and Supply so far. Maybe he brings the offer up. He'll get some platform company. He'll get it done. This is the guy I want to bet with for the next 10 years on home building supplies. So I'm sticking with Brad, even though he hasn't gotten a deal done yet. He's probably got more urgency to get it done and capacity to get it done than I have urgency for him to get it done, as we're holders of QXO. So I'll leave it at that. Goran says, look at Viavi. This is probably some software thing with no moat, so I'm going to probably not be interested, but I'll take a look. Yeah, so it's done nothing for 22 years. Why would anything change? Let's see if he has a thesis for it. Another stocking cycle about to begin. I mean, if they haven't had a stocking cycle in 22 years, they're probably not going to have one now. This looks like a dog, and it probably is a bunch of management that dilutes owners and issues a ton of stock. Cash flow's going down. Revenues are going down. Nothing I like about it yet. Let me just see if these guys are pigs, and I can save us a lot of time. If management doesn't respect equity and they make my slice of the pie smaller without my permission by diluting me and issuing shares to themselves or at bad prices, I will never do business with them. I like to say they're either going to leave or I'm going to leave, and more likely it's going to be me leaving. Okay, so they don't have an equity problem. So what kind of problem do they have? They have a low-quality business problem. They get a return on invested capital that's lower than their weighted average cost of capital, and that's the sign of a bad business with no moat. So I'm going to be a pass on that one. Patrick, how did you come across your current stock selections? Patrick, I mean, it's so funny. Just look at my daily reads, which very few people do. I mean, I read like 20, 30, 40 articles, maybe more, only 20, 30, 40 make it to my what I'm reading today list. That's starter. Then I get all the Wall Street research. Then I'm constantly screening stocks every single day. Then I've been reading annual reports and listening to conference calls for 20 some odd years. So when I see something, I can react. It's like, how could Buffett do an $8.5 billion deal with Goldman Sachs in 2008 from his bathtub? Because he's been studying the company for 20 years. So he could allocate $8.5 billion in 5 minutes, not because he was being reckless, because he knew the company. I know 90% of these companies, and I see how they respond through cycles. And when opportunity presents itself, it's like the plumber. He comes in the old joke, he comes in, he taps on the thing, he says, $400, it's fixed. They're like, $400, that only took you a minute. He goes, yeah, it was only $4 for the minute. It was $396 for the 20 years of expertise that told me where to tap on it, which took only 1 minute. And that's really what it comes down to. There's no shortcut. You got to do the work and experience it. And if you don't love the game, go build a business and lay it off to someone who's good, who does love the game and does it 24/7, that you're never going to be able to compete with because you don't have 2 sets of 24 hours in one day. Don L., do you think we're at the beginning of a nat gas super cycle given AI needs? Comstock or 100 or 200 could be a possibility due to euphoric markets. Don, who cares? At this point, I don't want to speculate. All I can tell you is its liquidation value is still, close to double where it is now. And then I'll take a look at what the fundamentals look like and all this super cycle headline nonsense. But look, if I come out of it on an $8 or $9 basis at $50 and I sell a bunch of it and keep a little bit of it and it goes to 300, I'm not going to lose sleep. I already made a 6-bagger in a couple of years. If I left a 12 or 24 bagger on the table, I'll keep a tail on it. I'll keep another 25% and let it run for a while. But that's all speculation. Who cares about that? But thank you for the nice question and highlighting one of the winners, because for those of you who know, we don't spend much time on our winners on this conference call. We tend to spend all the time on the ones that haven't left the station yet, which we enjoy doing. John Doe, insurers like Fairfax and Markel. Look, I have no idea what their exposure is to the California stuff. I know they're going to use it as an opportunity to increase prices. But no, I'm not buying Markel here. I mean, it's up almost triple since COVID. That's not when you buy insurers. You buy insurers when no one wants them, like Lincoln National a couple years. That's when you buy insurers. This is a low quality business. You bought it in the hole at $15. You got a 4-bagger just on recovery, cyclical type stuff. It's probably still cheap here because it's a low quality business. But Markel is a high quality business and it's trading at all time highs. So not interested. Fairfax. I mean, these are all, I want to be Warren Buffett. Well, everyone wants to be Warren Buffett, which is why they're fully priced. So you're not really adding any value by buying something that's trading at fully valued. So they're great businesses. You won't lose money investing them over time, but there's an opportunity cost. And, there's this whole kind of cadre of people that only buy the highest quality, blah, blah, blah. And then they buy them when everything is perfect and they're at all-time highs and a perfect return on capital. And what happens? They hit a cycle. The thing goes down 50%. They were right about it being high quality. They bought it at the wrong time, which is why I like taking B and C players when they're absolutely decimated, but I can be clear they're not going out of business, because then I'm going to get a triple. And I don't have to have the best quality one breaking out and all this bullshit. I can just buy a business that I know is not going out of business and make a double or triple over a few years, rinse and repeat over and over. So I'll leave that one there. Thank you for the question. Thanks for being a listener. Philippe Andrew Pincos is asking about China. Listen to their last call. They're very happy about China. I'm very happy about China. GlaxoSmithKline is from Chris C. I think many of these, kind of value pharma are going to start to do well, but this is not a good use of capital. You're lucky if you get a double over 3 or 4 years, and it's kind of a low quality business. You got to understand the pipeline, and if I don't have at least a guaranteed double in a short period of time, I'm not going to spend the time on it. So with this one, I mean, it's trading flat because the business has been flat. So if you can tell me that there's some amazing drug in the pipeline, I might listen, but that's not the business I do. So you think this recently Indie Semiconductor, which focus company like Indie Semiconductor, I'm not interested in those tiny little players because they're going to get smoked out. Sebastian, thoughts on Visteon? Probably not for me. Let me take a look at it. I would say, would I buy? Wait. Vistra Energy, would I buy it? No, hell no. Why are you bringing me a stock that's up 8x in a year? No, thank you. I hope it doubles again for you, but I'm not going to participate in it. QXO, we've already talked about it. If he executes right, it's an 8 to 10 bagger over a decade. Just eat takeaway. I'm not interested. I don't like delivery businesses. I think they're commoditized. Brian O'Kelly, Keeney, listener for last year. Thank you for the value. Share my customer with many of my restaurant customers. Thank you. That's very kind of you. Value ETF inside a 529 plan. I've got no complaints on that. I don't really like value ETFs because you get a lot of value traps. I like to just buy companies, but I don't think you get hurt there having some exposure that way. Jacob Saxtoff, thank you for all you do. Blah blah blah. AMD. Nah, I'm not interested in those. Alan asked me to take a look at Perigo. Perigo is okay. I think they're going to do fine. They've got a lot of over-the-counter stuff. They are a cash generator. I just don't know what the catalyst is for change here. And I don't want to be stuck in a value trap. But I do think this is going to work at some point. You do have a margin of safety. And I think, a lot of these single payers are going to have to move to more generics. It's okay. It's not for me. I've looked at it a million times, Alan, and I've done nothing. So that probably tells you everything you need to know. Christopher Hasselfield, ATS, Automation Products, EV Miner, similar to Rockwell. All right, ATS. Let's take a look. It's one I don't know. All right, so ATS. So, they're basically break-even cash flow. They're growing the revenues. Margins are declining. Doesn't look like they're generating enough cash flow for me to get interested. Let's take a look here. Let's see what the balance sheet looks like. 125 million. $800 million debt. Pretty leveraged balance sheet. Where's the cash flow? There it is. Nah, not for me. Not for me. Moving along. Okay, a miner. Not interested in miners. SBSW. Okay, this looks like a cyclical thing. SBSW. Negative free cash flow, declining revenues, cyclical business. I already have one in Albemarle, which I like. Precious metals mining. I hate precious metals mining. I mean, this is a trading vehicle. I would not want to own this business. It's a bad quality business, but it's probably going to work as a trade. I'll leave it at that. John Dabalek, National Oil, Welvarco. Yeah, again, it's a servicer. Someone asks every few weeks. I think it's probably okay. I just don't love it enough. I mean, it's it's been dead money for years. It didn't really recover with everything else. And maybe now's the time. Cash flows inflecting, revenues inflecting, margins going up. So look, there's some positive stuff. I think if you buy this, you're fine. Maybe you make a double, but let me take a closer look here, because I've looked at this thing over and over and done nothing and been right. But maybe now I'm going to start being wrong. But errors of omission, I'm good with, and just not errors of commission. It's never been a business that earned above its cost of capital. So it's a crappy business, but when they catch a cycle, they go. And they didn't catch the last cycle. They're still burning cash. You got $800 million, and how much debt? $1.7 billion. Let's see if they at least respect equity a little bit. Yeah, so. They're growing the share count a little bit. I don't think you're going to get hurt. I think maybe you get a double. It's okay. Kevin McAllister. LX for China small cap exposure. I don't want China small cap exposure. It's got to be the highest quality. I'm not taking company and country. I understand the thought on it. Not really interested. Foot Locker. Foot Locker is a play on Nike, ladies and gentlemen. Why don't you just buy Nike? I would just buy Nike. Don't buy Foot Locker. I'm not even going to look at it. Mastercraft Boat. This is like FOXF. Interest rates coming down. All the overstocks work through. So maybe these recreation things start to roll again. Craft. I mean, with all the boat parades they're going to be having with the Trump flags, maybe they'll sell a lot of boats now. Let's see. Mastercraft. Why is this not coming up? Are you sure it's not Malibu Boats? I think it's Malibu Boats, and they sell Mastercraft. I don't think this is ready yet. I've looked at this a bunch. I don't like these recreational things. The RV businesses. Let's see, Malibu Boats. Do they sell Mastercrafts? Well, it's the same thing. I mean, it's the same business. Let me see if these things are starting to inflect at all. I mean, revenues are still decimated. As a matter of fact, I have a friend who sells Boston Whalers and Chris Crafts and all that type of stuff. And they've gotten smoked the last couple of years. I mean, it's starting to stabilize a little bit. I think you might be early. I mean, these revenues are getting smoked. I would take a look at this inventory recovery. It's probably showing that they're working down inventories and maybe a restock cycle. This one, let me just take a look here. See if it's ever been a good business. Yeah. All right, I get it. See if they're going to live another day. $26 million of cash, is that right? How much debt do they have? Not much. And free cash flow. Negative. You really got to understand, is the turnaround real? I mean, is this legit? They're back to kind of pre-COVID-ish sales levels. And back then it was kind of trading where it is now. I think you got to do a lot more work, but I definitely see what you potentially see. Drew Robinson, Warby Parker, no interest. Jimmy Jones, Baxter, high PE ratio. All the stocks we buy probably have high PE ratios because at the time we buy them, they're in trough earnings cycle. So that we never even talk about PEs on this podcast. We talk about cash flow, we talk about revenues, we talk about margins, because when we're buying it, they're down 60, 80%, and they're going to be at negative or break even earnings. So you're going to have 100 times multiple if you're earning a penny and the stock is trading at $1. And if they have no earnings in the short term, which is very often in turnaround Tom's picks when they're down 80%, but we've seen them operate through decades of cycles, and we know that's what happens every cycle. Their multiple is infinite. So PE is not the right question. The right question is, what does their cash flow and earnings power look like pro forma when the kidney business is out and they pay down debt, their interest expense goes down, and the multiple re-rates, because the slowest growing part of their business, the kidney business, which pulled the multiple down from 18 down to 12, is now out of there, and all they're left with is a fast-growing business that warrants a higher multiple, and it re-rates from 12 times to 18 times and gets momentum and off to the races. So P is the wrong question. Mode is the right question. No one even compares in the IV business and the areas that they compete. Their pump business had a little bit of a softness. They now got the new pump out that's going to absolutely kick ass, and they're going to be off to the races. So love that one. Scott Wilson. Something about it. Resonated most with your recommendations, not advice. By the way, go to hedgefundtips.com, click on terms. All of this is opinion, not advice. Talk to your financial advisor. Don't do anything. Yada, yada, yada. Read terms. What is he talking here? Okay. No, Scott, you're right on point. Thanks for inviting me up to Ojai. Whenever I get up there, I will definitely look you up. And very grateful for your support over the year and recommending to your friends and colleagues. You're on the right track. Those are good tools to have. You could probably get Value Line at your local library if you want to do that. And very grateful for the kind words. Jeremy. All right, do GLP-1s hurt Hershey? Yes, they hurt Hershey, they hurt Diageo, but it's reflected in the price. Certainly in the case of Diageo. Hershey, there could be a little bit more hurt before it actually rock and rolls, but Hershey's is just one of the greatest businesses. And, look, not everyone's going to stay on these things. That's just the nature of the beast. So, I look, every week I look at Hershey and I'm interested and I do nothing. So, this will probably be one that I miss. I mean, at 100, it's at $150. If it got to $100, I wouldn't even have to think about it because so much is priced in, and I don't care if you're on 80 GLP-1s, you're still going to eat Reese's Pieces. I mean, who doesn't eat Reese's? The stuff is like crack. I mean, it's the best tasting thing in the world. So, and no one can replicate if you actually understand the Hershey business and how they have these special stones that take 10 years to replicate it. No one can replicate that particular flavor, which is also the moat of the Coca-Cola company. I think you'll find that Hershey's going to be just fine. So I would say I'm interested in Hershey. I'm aware of the GLP-1 issue, and there's not a big enough motor safety for me to back up the truck yet. And I fully expect that it'll run away from me before it gets to a point where I would back up the truck. And I'm perfectly okay with errors of omission, not errors of commission. Thoughts on Snap? I hate this business. I think, no, not for me. If it turns around, it turns around. But it's the same manager, and it's just been a dog forever. The idea is that if TikTok gets out, everyone's going to have to use Snap. I mean, you got to go through the whole thing. This guy's no Zuckerberg. This guy is a different level. He's in the Bush League. Zuckerberg is in the, pro league. And I just don't know how it turns around. I think there's a demographic that uses it every day, but it's like 5-year to 7-year window. The new young people don't use it at all. The middle young people use it a lot. This has never been a good business. Nah, not for me. Cheap for a reason. Alan, I covered the China thing on CPS. Let's try BART. Market access. I keep looking at it. I'm not really inclined to do anything. I know why you're looking at it. I think you're right to be looking at it. I think it's what? MKTX. Everything looks right. I just don't understand the moat and it. Yeah, it definitely is worthy of trading platform for institutional broker dealer company, liquidity and grade bonds, emerging market debt. I just find that these are race to the bottoms. I mean, you had Knight that blew up. I don't like this business, so I'm going to just say no, even though all the numbers look great. Jack Jensen, Walgreens Boots, temporary or permanent impairment. I wish I knew. I wish I knew. I think there are going to be. I think I got to sell off Boots, and then be kind of one of the last men standing in the U.S. And it's kind of a cigar butt, so it might work. I have no motivation to be involved in that, and I'm super happy to watch it double and triple without me. Matt Mitchell, Hershey, same question. Learned a credible amount. Thank you very much. Yeah, I agree. I just don't think it's at a level where I want to back up the truck, and I'm willing to miss it. So, but nice find. With that said, we'll be back next week, same time, same place. In the meantime, make it a great one. Bye for now.